Okay, let's get started. Good afternoon, everyone. Welcome to the Financial Bootcamp webinar, Understanding the Internet Gaming and Sports Wagering Business in New Jersey from a Financial Perspective. This webinar is being presented by the New Jersey Division of Gaming Enforcement and the Lloyd D. Levenson Institute of Gaming, Hospitality, and Tourism at Stockton University, also known as LIGHT. My name is Jane Buckinevage, and I'm the Faculty Director of LIGHT. Thank you all for joining us today. With the addition of internet gaming and sports wagering to New Jersey's gaming market, the financial reports produced by the Division of Gaming Enforcement each month have become more complex than ever. So our goal of this webinar is to help all interested parties understand the nuances of interpreting the data. And we are thrilled with the turnout that we have today. There were almost 150 people registered for the webinar. You are in good hands with our expert presenters from the New Jersey Division of Gaming Enforcement, Christopher Guam and Charity Yeoman. If you have any questions as we go through the session, please enter them in the Q&A tab at the bottom of the screen, and we'll hold all questions till the end. Thank you so much, and I hope you enjoy the presentation, and I'm turning it over to Christopher.
Thanks, Jane. Happy everybody can join. When we tried to put this together, we had no idea how many people would be interested. So it's great to hear that we're up between 100 and 150. So a little bit about myself. I started with the Casino Control Commission in 1987, transferred to the division in 2011. Currently oversee all casino licensing and financial investigations, operations, and licensing. Have an undergrad from Temple, master's from Rutgers. I'm a CPA in New Jersey, and I teach courses at Rowan and formerly taught at Stockton, Rutgers, and Drexel. So hopefully we're happy you all could join us. I'm going to turn it over to Charity to introduce herself.
Hi, everyone. My name is Charity Yeoman, and I also began my career with the Casino Control Commission as an inspector. I later served as an operations analyst, reviewing and approving internal controls. In 2011, I started my career with the Division of Gaming Enforcement. And over the past 14 years, I've served in several key areas, such as revenue certification, service industry licensing, casino licensing, and my current position as Administrator of Investigations for OFI. Currently I oversee a group of investigators that conduct complex financial investigations, and we are also in charge of all of the public financial reporting, which we'll talk about later in this presentation. And I received my bachelor's from Stockton University.
Thanks, Charity. So Charity, what are the goals? What are we doing today?
We have two really important goals here. So we're gonna identify the basic types of business arrangements used by the casinos and racetracks to monetize the internet gaming and sports wagering business in New Jersey. And then, after we learn all about those foreskin arrangements, we're going to understand how each arrangement impacts revenue and profits in the Atlantic City casinos. The presentation, however, doesn't focus on the income of the income of the racetracks with sports wagering.
Yeah, so just to follow up on that a little bit, in New Jersey, only casinos can offer internet gaming, and the casinos and our racetracks can offer sports wagering. From a financial reporting standpoint, all of the revenues are captured in our monthly reporting, both from casinos and racetracks. From a quarterly report or financial income statement standpoint, we only require data from the casinos, and that's what we make public. So you'll see throughout this presentation how we differentiate between the gross revenues and the income statements of the casinos.
All right. Now we have 5 different questions that we hope this presentation is going to answer. I'm going to read all 5 to you. Where can I find the financial information regarding internet gaming and sports wagering? How is gross revenue from internet gaming and sports wagering shared by casinos, racetracks, affiliates, and third-party operators? How does the internet gaming and sports wagering business impact the net revenue and gross operating profit of the casinos? And how does internet gaming and sports wagering impact the Casino Property Tax Stabilization Act, more commonly referred to as the pilot? And how has internet gaming and sports wagering impacted the gaming versus non-gaming revenue mix over the years? Next. And we have 6 topics. The first 3 topics will be covered by myself: the overview of internet gaming and sports wagering, the basic types of business arrangements, and the monthly and quarterly financial reporting. And the next 3 topics will be covered by Chief Glom: proportion of gross revenues reported by each business arrangement, the implications for the Atlantic City pilot, and understanding the revenue mix of an Atlantic City casino in 2025.
Just so that we're all clear, we're going to explain to you how the business works, and how the arrangements impact revenue and profits of the casinos in Atlantic City. What we will not be able to tell you is exactly the dollar amount of revenue sharing or distributions from any of the third-party entities to the Atlantic City casinos. That's considered proprietary information. So we will be able to tell you where to get information on whether a casino reports revenues and under which skin they do, but the exact dollar amount of the net revenue, expenses, and GOP is proprietary information. It makes it a little bit of a challenge from the user standpoint, but we'll talk about that as we move through the presentation. All right, so why are we here? Apparently 125 of you now have decided that this was a topic that you were interested in. That's great. But ever since 2013, when internet gaming started, there was a bit of a disconnect in the world as to who is receiving the revenues from internet gaming and then in sports. That started in 2018. So our focus is, I call it, focusing on the orange bar, which is the online gaming revenue segment of the Atlantic City business. Who's getting it, how they receive it, and what's the financial impact on the casinos. A lot of the information as we walk through is going to be public information and available to you. Unlike the past, however, it takes a little bit more work on the user side to be able to understand the business. So the gross revenues are easy to understand and report, but when it gets to the profitability, it gets a little more complicated, and that's because of the business arrangements that are in place. And we'll get into that a little bit later in the presentation. All right, so history. Prior to 2013, all we had were casinos. Very easy industry to understand. We had a peak of 5.2 billion in gross revenues in 2006. That was our high point. We are about 45% below that at present. The most primary cause for that is our regional competition from the casinos that are closest to us, including Pennsylvania. We had 5 casinos closed between 2014 and 2016, so it was recognized during that time frame that the casino industry needed some support, and that came initially in the form of internet gaming, which was legalized in 2013. Sports was legalized in 2018, and those who follow the industry know that it's the combination of the two that kind of really turbocharged the revenue growth in this market, as well as the impact of COVID on in-person gaming. So between those 3 factors, it's kind of where we're seeing the major growth that started around 2019. All right. So during this time frame, our online gaming revenues are growing significantly, and our land-based revenues are like I say, stabilized. So basically flat to up a couple percent each year. And at this point, our online gaming revenues exceed land-based revenues on an annualized basis. So if you take 2024, 55% of our gaming revenue came from online. And when we say online, that means internet and sports online combined. We have 45% from land-based casinos. So our business has changed. Our revenue structure has changed significantly in the past, pretty much the past 5 years. All right, so some of the reasons for online gaming growth, again, sports wagering, we cannot understate the impact that sports wagering had on internet gaming. Now you have multiple third parties and casinos that are offering both internet and sports, and can market to each other, which is definitely beneficial. The third-party brands, FanDuel, DraftKings, and the BetMGM joint venture As we'll see through the data when we move through the presentation, their significance cannot be understated in terms of their impact on the market and the market's growth. Again, COVID-19 created a favorable environment for online gaming as an alternate to in-person gaming. Talked about the cross-marketing synergies a little bit. Last point I want to make is internet gaming has a significant amount of offerings that can be made that can't be made in a live casino market. So there are an increasing inventory of internet games and slot games that are available online, which gives the customers a lot of options. Charity will talk about our first topic, which is just the overview of internet gaming and sports wagering.
All right. So early 2013, the enabling statute for internet gaming provided casino licensees in Atlantic City with the exclusive ability to operate online casinos. We launched our first online internet gaming in November. We have 9 licensees. Each licensee is allowed to have 5 internet gaming skins. So we have a cap of internet gaming skins at 45, of which 28 were operational as of July 31st. It was also widely recognized in the beginning that the Atlantic City casinos didn't have the ability or expertise to operate an online casino. So they partnered with experienced online operators, platform providers, etc., to be able to commence operations. Next slide. All right, overview of sports wagering. So 5 years later, we have early 2018, we got hit with sports wagering. Our first racetrack, Monmouth Park, opened up with William Hill Lounge in June. And then we offered our first online sports wagering in August of that year. So with online sports wagering, we are allowed to have 3 skins per casino and 3 skins per racetrack. So with 9 casinos and 2 racetracks, we're capped at 33 skins, of which 15 were operational July 31st, 2025. So similar to internet gaming, the racetracks and casinos need to enter into contractual agreements with online providers and platform providers in order to start their operations. Which brings us into our next topic, basic business arrangements. So there are 4 types of business arrangements, and this is going to answer one of our main topics that we wanted to provide to you today. So there are 4 different types of business arrangements that the casinos and racetracks have used in order to monetize the internet gaming business in New Jersey. So first and foremost is a casino skin. And a casino skin is very simply a skin that is run by the casino licensees. Currently, none of the racetracks operate their own skins, so we don't have a racetrack skin. Our next skin is an affiliate skin, and that is simply a skin that is operated by an affiliate or owner of a casino licensee. Then we have third-party skins. The most popular type of arrangement is where a casino or racetrack have entered into a contractual agreement with third parties in order to provide access to the New Jersey market in which they receive payments. And then we have one joint venture skin. We gave it away there. Borgata has it, in which a casino or their parent company can form a joint venture with an established online operator.
All right, so I want to jump in real quick. Again, this is when you see this slide's critical as we move forward. Again, I want to highlight the fact that when you have 5 skins available to you, Bally's is not going to have 5 Bally's casino skins. They're going to use one for themselves and then look to monetize their other skins through different approaches. Also, these are kind of we've made these 4 categories. Everything kind of fits into one of these 4 categories. So when we talk about it going forward, it's not like the division said in 2013, these are the 4 ways you can do it. In fact, it was the opposite. So when the casinos were given the ability to offer online gaming, basically this is what they came up with in terms of how they were going to monetize it. So it's when you boil it down, it is kind of simple. A casino says, I can run it myself. I can have an affiliate or my parent company own it. I could give it to a third-party operator and charge them a fee for giving them access to the market. Or as a casino or casino's parent company, they could get together with a established online brand, form a 50-50 joint venture and run the online business through that. So as a precursor to what we'll see going forward, when we're looking at like different times periods, one of the biggest things in addition to the growth you're going to see is the shift between, casino skins and affiliate skins, and the shift away from those and towards third parties and joint ventures. So those last two categories are going to be kind of what the industry looks like in 2024. Casino and affiliates are kind of what the industry looked like in 2016. For those of you on the presentation that have any involvement or interest in the Atlantic City pilot, we're also going to talk about 2021, because you'll be able to see the change in the market and how the shift impacted the pilot amendments that took place in 2021. You should be able to see it a lot clearer. This stuff is, a lot of this information is being public for the first time that we've in conjunction with this presentation. So it's important so that people understand and get the facts associated with some of the decisions the legislature was faced with at that time.
Okay.
Charity?
As Chris mentioned, we have evolved. So when we first started off, there were a few more casino skins than there are today. So as of today, we only have Bally Bet, which runs internet gaming and sports wagering, and Bet Ocean, which is an iGaming skin. They're the only casino skins today. And as I said before, there's no racetracks that conduct their own online sports wagering operations. Affiliate skins. So we have 6 affiliate skins. Caesar's Palace and Sportsbook. They're affiliated with Tropicana and they're run by William Hill. The 3 Tropicana Casino, Harris Casino, and World Series of Poker affiliated with Tropicana. They're run by CINJ. All 3 of those are internet gaming skins. We have Hard Rock Bet that has an internet gaming and a sports wagering skin. They're affiliated with Hard Rock, but run by Hard Rock Digital. And then last but not least, we have Monopoly, an internet gaming skin with Bally's, and it's run by GameSys. So
I
there's
just want to add a little, I'm sorry, Charlie. Yeah, it's add a little distinction between casino skin and affiliate. So affiliate means that the skin is run by an affiliate or a parent company. So none of that revenue would show up on the income statement of a casino here because they're not being run by the casino. So the only 2 casino skins where there would be revenue and expenses and profit from would be the 2 Bally Bet and Ocean. All right, so these affiliate skins, to the extent that they provide a payment to the licensee, that payment would be in the revenue, but nothing else would be in the revenue. And that, as you'll see when we move through, that creates a big deviation between what we report for tax purposes and what the casinos are reporting as revenue.
All right. Here's our long list of third-party skins, all 19 of them. So as Chris mentioned earlier, this is the most popular type of business arrangement that we have today, although that wasn't always the case. And in third-party skins, again, they enter into contracts with the third-party providers, and the casino licensee or the sports book receives a contractual fee.
So I just want to highlight a few things here. We use the term skin brand here because how the casino skin is branded is how you see it online. There are a couple of casinos that have different partners. So FanDuel has their internet gaming run through Golden Nugget and their sports through Meadowlands. Bet Rivers has their internet gaming running through Golden Nugget and their sports with Monmouth. So that's why there's 2 for those. And the other thing is that not all 19 have both an internet gaming and sports wagering operation. So some of them, most of them have both. Some of them have only sports, and I think there's a few with only internet gaming. All right, so there's 19 brands that are, between both internet gaming and sports.
Okay, joint venture skins, as we mentioned before, only Borgata has a joint venture with Entain. And BetMGM, well, it's BetMGM and Entain, and BetMGM runs the 4 skins, BetMGM, Borgata, Party Poker, and Wheel of Fortune. Borgata also has another skin, Pala. Stardust is a skin, which is run by Pala, but BetMGM receives the contractual fee for that. And with these joint venture skins, there is no revenue recognition for Borgata. All the revenue recognition is with the joint venture. So we don't see anything on Borgata's financial statements from these skins.
Yeah, and you'll see that when we get to the reporting, we'll tell you exactly where you can go to find the information on whether there's a revenue impact on the casino itself. So through the footnote disclosures and the requirements that the Division of Gaming Enforcement has put in place, users have the ability to find out what skins are affiliated with each casino and whether or not they provide revenues to the casino licensee. So we'll show you that in the next section, I believe.
Okay, monthly and quarterly financial reporting. So that is my group. We're responsible for all the public financial reporting. So this is a good section for me. Monthly public data. So for those of you who aren't familiar, our DGE monthly press release is a month and year-to-date report of the gross revenue and taxes from land-based casinos, internet gaming, sports wagering, as well as sports wagering stats. So if you click that link right there, it should be live for you. It will take you to the DGE's website that will show all of our DGE monthly press releases dating back to 2016. The next bullet down is all of the monthly gross revenue reports. That link is also live and will also take you back to the reports to 2016. The monthly gross revenue reports are the brick and mortar casino revenue reports that we commonly refer to as the DGE 101s. And we use all of those reports that the licensees submit in order to prepare our monthly press release. On the next slide, you'll see the next link is our monthly internet gaming gross revenue reports, which are commonly referred to as our DGE 105s. That link will also take you to the DGE 105s dating back to 2016. And the last link is the monthly sports wagering revenue reports, DGE 107s. And we use both of those as well to compile the information for our monthly press release. So in the next section, about quarterly public data, let's talk about that first. I wanted to jump into my monthly press release changes. So we have the DG quarterly press release 2 that OFI puts together. It's a quarter and year-to-date report of net revenue and gross operating profit and the room statistics for the casinos. That link takes you to all of our press releases dating back to 2015. And associated with that, the quarterly financial reports for each casino. That link will take you to all of those for each of the licensees dating back to 2015 as well. We use those quarterly financial reports to compile our DGE quarterly press release.
All right, just want to jump in real quick. The distinction between the monthly data and the quarterly data, the monthly data is basically all the taxable information, casino win, internet gaming win, and sports wagering gross revenue. The quarterly is basically a financial report with an income statement, balance sheet, cash flows, that type of information. And it's in between the two that you get the distinction of, okay, so we have, in excess of $6 billion in revenues from 3 gaming sources, but the casinos are only reporting, $2 billion. We'll walk you through that at the end of the presentation as to what it looked like back in 2006 versus what it looks like now.
Okay, recent financial reporting changes. So the Casino Control Act required the division to provide a minimum uniform standard of accountancy methods to assure consistency and comparability for the disclosure of all financial information. So due to all the different skin arrangements we have, it became very difficult to be able to compare all of the different licensees as far as their financial statements go. So consistency and comparability became very challenging. So accordingly, the division took many steps to improve that consistency, comparability, and transparency for the public reporting of internet gaming and sports wagering. So how did we do that? With the monthly revenue reports, so prior to 2024, our internet gaming and sports wagering gross revenue was reported on a combined basis on our monthly revenue reports. So on the DGE 105s and 107s, publicly you only saw one page, and that had a combined number for all of the sports wagering and sports wagering number and an internet gaming number. So no matter how many skins you had, you only saw one number. So Resorts has 5 skins. Whatever their gross revenue was for the month, all of those skins were combined, and you couldn't disseminate what money came from DraftKings or what money came from Mohegan. So due largely to the growth in internet gaming and sports wagering in New Jersey, as well as attempts by industry analysts to estimate that revenue for the individual skins, we made changes to our gross revenue reports starting in January 2024. However, we didn't change our monthly press release. So we'll talk about the changes to the DGE 105s and 107s on the next slide. Changes to the monthly press release. So my fault. To further improve the transparency related to the public reporting of internet gaming and sports wagering, we also made changes to the monthly press release starting in 2025. So most significantly, the gross revenue for internet gaming and sports wagering is now reported by skin rather than by casino or racetrack. So with our monthly press release prior, on the monthly page, we had the casino licensee, and then we would have its casino win, its internet gaming win, and sports wagering win in a combined number. However, we changed that in 2025 to we have one page that will show you the casino win broken down by tables and slots. Then our next page will show you everyone's internet gaming win broken down by all of the skins. So you have a skin line. It will show you the casino or the casino affiliation for internet gaming, and then a monthly number and a year-to-date number. And we sort that for you from highest year-to-date gross revenue to lowest. And we did the same thing with sports wagering. So instead of having one sports wagering number for resorts, we broke it down for all of the casinos. We broke it down to all of the different sports wagering skins. We showed you what casino or racetrack they were affiliated with, and then gave you the month and year-to-date number.
So we're going to walk you through an example for resorts where we believe it most clearly reflects the way that the data should be presented in 2025 versus the way it had been done previously. The one thing that everybody should keep in mind is we started this, and even in the early years of sports wagering, we did not derive a lot of revenues from sports and iGaming. Those are more recent occurrences. So it made us, look back and understand, okay, I think the way we're presenting this may not be as helpful to people now. Maybe it made sense at a point in time, but it may not make sense anymore. And that's a lot of the motivations that we had in the last 2 years to kind of make this data public. And also the pilot was a big aspect as well. We at the Division of Gaming Enforcement understood who was generating the revenues associated with online sports and internet gaming, and it was not the casinos at that point in time. But our reporting was such that you could not, we would put in our press release, it's money generated by casinos and partners, but nobody really understood kind of what that meant. So this kind of cleaned, in our opinion, cleaned all of that up and puts us in a better position for moving forward. So Charity, you want to take us through the resorts example?
Sure. So Resorts is partnered with DraftKings. Everyone knows DraftKings, and it's a third-party operator that is among the highest producing internet gaming and sports wagering operators in New Jersey. Everyone knows DraftKings and FanDuel. So in September of 24, Resorts sold their Resorts and Mohegan Sun branded skins to an affiliate of Boyd. So currently Resorts only has third-party skins. They don't run any of their skins. So accordingly, the revenues in the monthly press release which prior reflected that basically it appeared as though all of the revenues were resorts revenues. Now it's broken out, and you will see on the next slide. Let's open up. So in our former press release, that casino win you see there, that $94.4 million is resorts brick and mortar casino win. Their total internet gaming win in our prior press release would show that 370 million. And then you would see in line for total sports wagering at 190 million. So it appeared as though resorts had $654 million in gross revenue, which in actuality, our current press release shows that they still have their $93.4 million in casino win. However, that internet gaming win is broken down by all of the different third-party operators. And the number is still the same, but you see that it's really the third-party operators that they're only receiving a contractual fee for. They're not actually the primary recipient of all of that gross revenue, that 370 million. The same thing with sports wagering. So that 190 million is broken down between DraftKings and ESPN Bet. However, the retail sports wagering, 108,000, is also shown under resorts. So in actuality, instead of 100% of the gross revenues, resorts is only at 14.3% of the gross revenues, and 85.7 is third-party gross revenues. So as Chris mentioned before, our prior press release, stated that it was resorts and their partners, but a lot of people
Didn't view it that way.
Yeah, they didn't view it that way, and they thought resorts was making all of that money, and in reality, they just get whatever their contractual fee is with each of the different third-party operators.
Yeah, so it's good. Thanks, Charity. So basically the left or the first column you see is if had we kept reporting unchanged in 2025, that's what you would have seen. And for, in our opinion, obvious reasons, it didn't make sense to continue doing that since, the majority of the revenues were going to the third party entity and not to resorts. Again, resorts is going to be an extreme example of this, but this is kind of similar throughout the industry. So Charity is going to walk through this information on this preceding slide is all publicly available and very easy to get. So, the next slides are say basically, okay, where did you get this information from to be able to put this together? One little area, well, I'll let Charity walk through that.
Thanks, Chris. So, all of the data we just talked about does come from our new monthly press release that I was trying to describe to you before, but these are the actual slides and actual pages of our press release. So pages 4, 5, and 6 are very important, and these are the pages that we changed from our old press release to our new press release. So first slide, page 4. Casino win. As I was talking before, we used to only see in our prior monthly press release, we would see all of the casinos and we would see the total casino win. We didn't see the breakdown between slot and table. So we, while it's not related to internet gaming or sports wagering, that was a plus with our new press release. You got that granular information by casino in the actual press release. So here you see resorts number, the $93.4 million was their total casino win. All right, this was the big change, the internet gaming win. So here you see the breakdown of all of the different brands that we have broken down. Also is the casino that is affiliated with. So you see all of the resorts skins are highlighted there. And then you see all of the year-to-date revenue highlighted, which will equal the number, the 370 million that we saw on the prior slide. So that is where you get all of your information for internet gaming for resorts. And then you can do the same thing with each one of the licensees. So we give you the month and year to date here versus having it on 2 different slides and not broken down by skin. We've done the same thing with online sports wagering. So you see here DraftKings and ESPN bet for resorts that will total their $190.1 million that we saw on the prior slide. And again, you can do the same thing if you want to break it down by each individual casino or racetrack. The information is here for you, broken down by month and year to date. And then with retail sports wagering, we kept it by licensee because the lounge is inside the brick and mortar casino. So there you will see the resorts sports wagering lounge had the basically $8,000 in revenue for the year to date ended July. So those were the major changes from our former press release to our new version of our press release. Just making it was already public in our gross revenue reports. We had the second page detail skin that we made public in 2024. Not sure how many people were looking at that, but it was public in 2024. Now we just presented it in our monthly press release as it was already public. We made the presentation better in this press release by showing you all of the combined licensee skins together in one page, one snapshot. Okay. So we also made changes to our quarterly press release and the quarterly financial reports. So from a DGE perspective, we gave a new footnote on the quarterly press release and some additional information on the notes page. And then we also required the casino licensees to provide additional information in their quarterly reports and in the footnotes of their quarterly reports, including a nice table that sums up all of the information. And we'll see that on the next slides.
And Jane, don't laugh at us because now we'll say that the footnotes are important for the first time in history.
So yes, and we are going to emphasize that. So the first thing that we added on page 1 of our quarterly press release was a note, and I'm going to read the note because it is so very important. So important information regarding the net revenue and gross operating profit recognition related to the internet gaming and sports wagering business is contained in the footnotes of the quarterly financial report. Valid comparisons cannot be made without using the information contained in the footnotes. You must read the footnotes in order to get a good understanding of what's going on with these internet gaming and sports wagering skins.
Yeah. So again, this is the treatment of the revenue treatment by the casinos is important here. You're going to have some casinos that have no revenue. You're going to have some casinos that have revenue only from third-party agreements. And you'll have other casinos that report all of the revenue and expenses because they're the ones that are running the online site. So from a comparability standpoint, it is not possible basically anymore from a comparability standpoint to have apples to apples or focusing on casinos only because of the way the business arrangements. And then we'll talk about those. So when we talk about those 4 business arrangements, we'll also take a look at what revenue gets recognized under each of those 4. And it's actually on this slide. So, whether you knew it or not, this slide was important when we issued the quarterly press releases thus far in 2025. So Charity?
Absolutely. So this is basically the key right here. What the information that we have here. So the first little top bullet will talk about all the different skins. Like we said, casino skins, number 1, affiliate skins, third party, so unaffiliated operators through their third parties and the joint ventures. But the key information is down in those 1, 2, 3 bullets. So a casino licensee operation reports 100% of the net revenue and gross operating profit on their income statement. So those 2 casino skin brands that we talked about, you'll see that information on their income statement. Anyone who is an affiliate or a third party, it all depends on their distributions and what they're going to show on their income statement. All depends on their contractual agreement. And then with the joint ventures, as we talked about before, the licensee will show nothing on their income statement. Everything regarding the joint venture is reported on the joint ventures income statements, which we're not privy to and we don't have. So that information there that we added in the notes section is very important in understanding what we now made the licensees include in their footnotes.
So just jump in real quick. Take a little step back here from a revenue perspective. If a casino runs their own operation, they're going to include all of the revenue and expenses. I think that's the easy part. For the affiliates and third parties, it's all driven by the contractual arrangement. So in other words, the affiliate or the third party are the ones that are generating the revenues, and they're giving a piece of that, whatever that is under a contractual arrangement, to the casino licensee. From the casino licensee standpoint, they're only getting that piece of money from the third party. So they don't record all of the revenue. And that creates that, again, that big disparity between what we're talking about in revenues, gross revenues, versus what the casinos are actually receiving. And there are also some of the affiliated operators that don't provide a payment to the licensees. Which makes sense. So if I'm Caesar's World, I don't need to pay Caesar's, the licensee that I own in Atlantic City, for its, for a portion of the revenue. So again, when we get to individual footnotes, we'll show you where you can find whether or not a specific skin is providing revenues to a casino licensee. We will not tell you how much, because that's proprietary, but you will know whether or not revenue is being reported by the casino licensee. Touch on one more thing with the joint ventures. When we talk about joint ventures throughout this presentation, it's all based on the relationship of Borgata to BetMGM. That doesn't mean somebody else can form a joint venture and operate differently. So this is not intended to be, every joint venture one size fits all. This is specific to the arrangement between Borgata and BetMGM.
Okay, changes to our quarterly report footnotes. So we required each licensee to disclose the following regarding their internet gaming and sports wagering skins in their footnotes supporting their financial reports. So we needed to know the number of internet gaming and sports wagering skins in use, a brief description, when the skin started, whether it operated internet gaming or sports wagering, and the name of their affiliate or owner, operator of each skin. Also, the revenue and expense recognition, which is very important. So the licensee, if the licensee reports all revenue and expenses, it will say 100%. If there is a revenue sharing or contractual fee arrangement, it will say that, or it will say none if they receive no payment. In addition, example.
Go ahead. Sorry.
No. So it's next. It's the following slide. The chart was what I was going to go, but I forgot. We had this nice example of Bally's third-party skin, and this is an actual excerpt from their footnotes regarding the PointsBet Fanatics skin, where they talk about their agreement, when it started, when it amended, their migration from PointsBet to Fanatics, and it talks about the annual fee that they're getting, and that there's no expenses recorded for this skin on their financial statement. So it gives a nice brief overview of the skin and gives a lot of good information. And so we require that of all active skins for them to give us some type of description. In addition to, which will be the next slide, the quarterly report footnote. So this is the chart that we required every licensee to have in their footnotes, which quickly identifies all of their skins, the owner operator, the date they started, whether it was sports wagering or internet gaming or both, and the revenue recognition. So this chart was really key for us to make standard throughout each of the financial statements. So you can see here that, Bally's has just one skin where it recognizes all of the revenue. Ballybet, as we talked about before, it has a couple skins that are just contractual payments, and then Monopoly where it doesn't recognize anything. So it's a nice mix here. You can see everything together. And that chart is, like I said, in every single footnote for each of the licensees.
So just to follow up on Charity, the terms that we're using here, casino skin, affiliate skin, third-party skin, and joint venture skin, are for the purposes of us in being able to categorize each type of skin operation. You won't necessarily see those words in the footnotes. So if you're looking for what points you to which category it would be in, I would focus on the revenue recognition. So anywhere you see contractual payments, that would be a third-party agreement. Whenever you see 100% of revenue, that would be a casino skin. And if you see none, that would be an affiliate skin. All right. So if it's a third party, nobody's giving third party skins away for free. So every third party is going to be a contractual payment. For affiliates and owners of casinos, they're the only ones that can have no revenue recognition associated with the skins that the affiliate is operating. So it should be an easy way for users to look at that grid and easily say, okay, they have two third-party agreements, one casino skin and one affiliate skin.
Okay. And this is also directly from Borgata's financial report footnotes. And here we wanted to highlight that BetMGM is entitled to 100% net economics generated. So this results in the company recording no net revenues and no expenses related to the retail sports wagering lounge, internet gaming, and sports wagering skins. So again, with this joint venture, all of the net economics are recorded by BetMGM. And it gives, again, as we required, a nice description of the agreement that they have with as a joint venture with Entain.
Yep. And again, all publicly disclosed. Like all we're pointing out here is data that already, or pointing you to the data that's already been made public by us for all of 2025. A lot of the information was also available in 24 and previous years, but we did make a concerted effort in 25, especially with the table, to be able to, try to have users have the ability to not, weed through paragraphs and paragraphs of information.
So this is Borgata's chart. And with this chart, I just would like to point out that, we classified the Palace Stardust skin as a third-party skin, which would normally receive contractual payments. However, those contractual payments are received by BetMGM. So as far as Borgata Atlantic City's revenue recognition, that's why there is none for the Palace Stardust skin. So again, all of the information right here in one spot, so you can quickly reference for your internet gaming sports wagering skins in the financial report footnotes. And then we have a next slide, the Borgata BetMGM summary. Borgata's retail sportsbook and all of its skins are operated through BetMGM, through that joint venture. So, and we said it, I've said it a couple of times already, but Borgata reports no revenue, expenses, or GOP associated with internet gaming or sports wagering. And they utilize all 5 of their internet gaming skins and only 2 of their 3 online sports wagering skins. All right.
All right, the fun has ended, so I'm taking over from Charity at this point. This next topic, now that we can kind of classify each type of business arrangement, we're going to take the next step and kind of put the revenues in each of those categories and see how the industry has changed, both from a growth standpoint and overall revenues, as well as where those revenues are in terms of the categories we had talked about previously. So in that, we're going to look at 3 specific years. We're going to look at 2016. For those interested in the pilot, which we'll get to in a little bit, that's the year the pilot commenced. So when, in terms of what the legislators were thinking at that point in time, you were looking at a very, very low internet gaming revenue mix, and then you had no sports wagering in 2016. So the pilot that was constructed in 2016, the original pilot, we call it, was made sense at that point in time. In 2021, we take a look at that year because now we have much higher online gaming revenues. We have, very, very strong third-party operators. And there's significant changes that occur between 2016 to 2021. And then we put in the most recently completed year and look again at the shift. So we'll go from 16 to 21 and then from 21 to 24. Right. So in the online world, the iGaming gross revenues basically went up sixfold during that time frame. So online sports didn't exist, and we did 740 in revenue in 2021. So combined, we were tenfold growth over that time period. We were only 197 million in 2016, and we were 2.1 billion in 2021. So we'll talk about the key operators who fueled that growth. And then we'll talk about how it changed the shift away from casinos and affiliates towards the joint ventures and third parties. All right, so this is the change between 16 and 21. All right, so third party skins, roughly $60 million in revenue in 16. They're over 1.2 billion in 21. We didn't have joint venture skins in 16. They were 481 in 21. Affiliate skins went from 52 to 283 million, and casino skins went from 85 to 123. So overall, we went from roughly a $200 million market to a $2.1 billion market. Then the question that comes is, okay, we know third parties is significant, but who were the main drivers of that growth? And what we call them is basically the big three. All right, so FanDuel, DraftKings, and BetMGM, none of them were operating in 2016. But in 2021, they were the three highest internet gaming and sports wagering revenue producers by a wide margin. Just a note that all of the revenues that we look at in here are combined, right? So for FanDuel, it's both the internet gaming and sports together, as well as for BetMGM and DraftKings. So in 2021, FanDuel was the industry leader in online revenues at 557 million. BetMGM was second at that point in time with 482, and DraftKings was third at 370. The key from a market or understanding the market perspective is that the next highest skin was at 105. All right, so clearly by 2021, we had three very, very strong online operators who were well ahead of their peers in terms of gross revenues. So if you take just the FanDuel, BetMGM, and DraftKings revenues, we had growth of 1.4 billion in total, and roughly 74% of that growth came from those three entities. So the overwhelming majority of the revenue growth was driven essentially by those three operators. Of course, with them coming in line, doing the revenues that they're doing, that's going to change the mix of where these revenues are coming from. So the next slide kind of gives us an indication of where we were in 2016. All right, so broken down by type of arrangement, we were roughly 70% casino and affiliates. All right, so that's the right-hand side of the 2016 pie chart, which is the 26.4 for affiliates, 43% for casinos. And we were only 30% third party at that point in time. And you can see the drastic change in 2021. So now third party skins are about 60% of the market. Casinos and affiliates have shrunk to 13.4 and 6% respectively. And then joint venture skins were 22.9, and those joint venture skins didn't exist in 2016. So you see the shift in the categories. Again, that plays a big role, and we'll revisit it when we talk about the pilot. But this slide, by and large, gives you the central question to the whole pilot when it comes to whether internet gaming revenues should be included in determining what that pilot payment should be. This is what the legislature had to deal with in addressing that question. All right, so just to summarize that time frame, obviously the internet and sports wagering landscape changed drastically. We had the big three operators generating the bulk of the revenue growth. The proportions changed such that third parties now become the dominant vehicle through which casinos have monetized the internet gaming and sports wagering business. And we'll get to the pilot in the next section. All right, so we then took the next step of taking where we were in 2021 to see kind of where we are today, roughly, or the last completed calendar year, which is 2024. Basically, the same thing happens between 21 and 24 that happens between 16 and 21, but not to the magnitude that it did between 16 and 21. So you have those big three operators, FanDuel, DraftKings, and BetMGM, again being the drivers of the growth over that 3-year period as well. We had a lot of new operators entering the market, which helped the overall growth. We also had some transactions that impacted the categories, right? So Golden Nugget and Resorts during this time frame, they both sold their online operations to third-party operators. So what happens in this instance is that you have a skin that was formerly in the casino or affiliate category now becoming a third-party skin. So because of all of that, the market dominance by third-party skins has expanded, and the market share held by casinos and affiliates has declined further. All right, so there's the data moving from 21 to 24. All right, so we're up another 64% in online revenues during that 3-year period. Most of that growth will be from FanDuel, DraftKings, and BetMGM. Our third-party skins now represent 68% of gross revenue, which is up roughly 10 percentage points from 2021. Joint venture skins are down, affiliate skins are down, and casino skins are down, all relative to 2021. So again, the shift that we saw from 16 to 21 has continued through 2024. And the big one there is that the casino skins are now only 3% of the gross revenue based on the 24 data, which is low in and of itself, but it's half of what it was even in 2021. All right, so looking at the big three, FanDuel, DraftKings, and BetMGM. So let's look at their revenues in 2024. We see again, massive growth from those three. So FanDuel did almost $1 billion in gross revenues combined for 2024 versus $557 in 2021. DraftKings was up at in excess of $800 million versus $370 for 2021. BetMGM was at $618 versus $482. Our fourth highest skin, which is Caesars Palace, was at $185. So if we looked at the slide for 2021, I think there's roughly a $200 or so million gap between the next highest operator. That has since expanded. So the three most largest operators continue to grow both themselves and the market as a whole. And we threw this in for comparison's sake. The highest casino in our market is Borgata, who did $738 million in revenue, in gross revenue for 2024. So if you were ranking the operators in the market, FanDuel is the first, DraftKings is second, and Borgata, the retail casino, is third. A lot of times if I'm doing talking to people and doing kind of presentations, I would say, who's the largest gross revenue producer? Everybody says Borgata without thinking. By now, that is no longer the case. So FanDuel and DraftKings are in excess of our largest land-based operator. So in terms of those three operators and what they've contributed to the overall growth, they reflected 73% of the growth during that 21 to 24 timeframe. So again, I think they were 74% of the growth from 16 to 21, and they represented 73% of the growth between 21 and 24. Okay, so let's get into the pilot. Again, just briefly in terms of the question of the revenues, because that's the significant piece of the puzzle, and was kind of a subject of litigation. All right, so again, as background, the original pilot went into effect in mid-2016, and 3 revenue streams were created to support the city of Atlantic City. One was a payment in lieu of real estate taxes, or pilot, that started in 2017 at $120 million. There was a redirection of the investment alternative tax payments to fund Atlantic City's debt service, and then casinos had to make a separate payment that started at $30 million a year and was gradually reduced to $5 million per year. We're not going to focus on the investment alternative tax payments or the separate state payment. Our focus is going to be on number one, which is the pilot and how that was calculated, and what the online business did from that standpoint. All right, so from the pilot aspect, the initial pilot payment was $120 million, and subsequent pilot payments were based on gross gaming revenue, or GGR. So you may see that term out in public, and that's what that means in terms of the pilot. Keys to remember. Number one, we didn't have sports when the pilot started. Excuse me. So prior to sports wagering, that gross gaming revenue consisted of the casino gross revenue and internet gaming gross revenue. All right, so the sum of both of those determined GGR at the outset. When sports wagering commenced, sports wagering from the casinos was added to that calculation, and that was done by statute. When the sports wagering was became legal, they added that to the pilot amount. Key distinction here for anybody who has anything to any interest in doing this themselves, God bless you. But the racetrack sports wagering is not included in GGR. So from the pilot standpoint, the focus of GGR is only the casinos that are in Atlantic City. So if you eliminate the sports wagering gross revenues from racetracks, you can figure out what that number is, and we'll provide it to you in the presentation to kind of give you an understanding of what those numbers were. So what were the issues that came up between 2017 and 2021 that caused the debate for the legislature to address internet gaming and sports wagering? Well, the first issue was that the total pilot payments the industry had to pay were based on revenues that they didn't receive. All right, so when we think back of the slides on the sports wagering and internet by third parties, under the pilot from 17 to 21, casinos were paying a pilot that were based on those revenues. Right, so industry pilots are based on GGR, which included all internet gaming and all sports wagering gross revenues, but 75% of the online revenues came from third parties or joint ventures, not casinos or affiliates. So that was one issue that the legislature faced, is that they're basing total pilot payments on revenues casinos aren't receiving. The other issue was that the individual pilot payments were also based on the gross revenues for every skin operating under their license, including third-party skins. So the best example that we have of this is that resorts, and then also Golden Nugget to a certain extent, resorts pilot payment, had the definition not changed, resorts would be making a pilot payment based on DraftKings revenue that they weren't receiving. So those were the two issues that the legislature had to deal with in terms of the amendments of the pilot that went through in 2021. All right, so just again, we talked about this briefly prior, is, you know, when the pilot went into effect, you know, we all need to understand the market that existed at that point in time. So we didn't have sports, and internet was less than $200 million. So when you're talking about GGR, or the amount of revenues in the industry, 92% of that came from the land-based revenues, and only 8% of it came from the internet gaming. So it made sense at that time to include all internet gaming GGR in gross revenue. In addition, if you think back a couple slides, in 2016, we were roughly 70-30 in terms of the revenues generated by casino skins and affiliate skins. So 70% of our revenues in 2016 came from casinos and affiliates, and only 30% came from third parties. So all of those combined, it made sense for GGR to be defined as it was at that point in time. So flash forward, sports wagering starts in 2018, and then the third party revenues start to explode. That creates the the pilot issue of the total payment that is due for Atlantic City casinos as a whole. All right, so next slide basically summarizes every year's GGR and what the resulting pilot amount would be. All right, so for 2017, we were at roughly 2.476 and then the pilot for that was 120 million. We bumped up at one tier in 2018, and we stayed there in 2019. All right, so the pilot was 130 for each of those years. Interestingly, 2020, the COVID year. So what we need to keep in mind is that the pilot's based on the prior year's revenues. So the 2020 amount that's actually 2019's revenues, which reached 3.3 billion. But that's where you're starting to see kind of the growth in the online gross revenues really starting to take hold in that year. 21 winds up being lower because of the COVID situation, but still a pilot of 130. And then had nothing been done on the pilot, you were looking at GGR totaling 4.3 billion in 2022 and a pilot amount of 165 million. All right, so that 2022 is basically what would have happened if nothing, if no legislative changes were made. All right, so the second issue is the individual pilot payment. So we were looking at basically a $35 million increase in the pilot payment from 130 for 21 to 165. That would, hit the 9 casinos, but it would not hit them proportionately. So in other words, all casinos wouldn't be paying, say, $6 million more. Formulaically, their payments would be driven by not only their revenues, but the revenues of their third-party partners. All right, so that impact would be disproportionate among the casinos, especially those who were partnered with the stronger third-party operators such as FanDuel and DraftKings. All right, so in Resort's case, they were facing a 360% increase in their pilot payment for 2022, basically due to the revenues of DraftKings. Golden Nugget would have seen a 174% increase for 2022 based on the revenues of FanDuel. And the key to remember there for Golden Nugget is FanDuel is only with Golden Nugget for internet gaming. Their sports is with Meadowlands. So Golden Nugget's pilot payment was only because of the online gaming revenue from FanDuel. All right, so that's the second issue that was facing legislators as they were working through the amendments to the pilot. So here's the example we looked at before, and I was going to do it based on 2021 data, but I think it's easier looking at the data that we had just shown you previously, right? So going back to resorts, if the original pilot calculation was in effect in 2025, what this would look like, right? So for resorts, their revenues are only in the neighborhood of $94 million. Under the new pilot calculation, that's what their payment is based on, that 94 million. Had the original pilot been in effect, their pilot payment would be driven by the 654 million in revenues. So it was clear to us, it was clear to many that maybe it was not appropriate to continue using GGR for internet and sports, especially the third parties, and including that into the pilot calculation. So again, this is this is kind of newer information that has not been shared previously. Now that we're making a lot of this information public, that's why we're able to discuss it at this point in time. So you don't have to answer this question for my benefit, but the question here is that should Resorts' pilot payment be based on the 654 or the 94 that they're actually generating? So that's the $64,000 question that the legislature had to deal with. And also just to highlight something else is that when we say reported by third party, we do acknowledge that there are fee payments made by the third party. So that's just, that's not factored into, that's why we say primary beneficiary, right? So if somebody's, if a third party is getting 85% of the revenue and a casino is getting 15, the third party is the primary beneficiary, right? All right, so what's the key issue for the legislature? The pilot was intended to be a replacement for real estate taxes paid by the casinos physically located in Atlantic City. So the legislature needed to determine whether it would be appropriate to continue including internet and sports in the GGR calculations, and if so, to what extent. Right. So focusing solely on casinos, the following slide highlights the shift in the percentage of revenues from casinos and affiliates to third parties between 16 and 21, or during that time frame that the pilot was in existence. So just to be clear and hopefully not confuse people, the slides that we've been looking at up until now were the industry as a whole, including the racetracks. All right, so that's what we looked at in the former slides. Since the pilot is only based on casinos, this slide is going to have little different numbers. Basically, we net out the racetracks and their partners in these calculations. All right, again, similar appearance of the table, but different data, a little less because we took out the racetracks. So again, only casinos had internet gaming, so that's why the 2016 numbers haven't changed. The 2021 numbers are net of the racetracks and their sports wagering third-party partners. All right. So gross revenues went from roughly 200 million to 1.7 billion, with most of that generated by the third parties and joint ventures. All right. So on the right-hand side, we see some of that information. Roughly 73% of the growth during that time frame is from the three entities that didn't exist in 2016. So BetMGM at 482, DraftKings at 370, FanDuel at 206. That's internet only, as their sports was with Meadowlands. So third-party skins was 40% of gross revenue, which is up 15, over 31% in 2016. And then the joint venture skins were nothing or no percentage in 16, and there were 29% in 2021. All right. So the shift, we were roughly 70-30 for casinos and affiliates in 2016, and that's kind of basically reversed itself. So affiliate skins were reduced by 9%. Casino skins were down 36 percentage points. And that shift went to the third parties and the joint venture. So clearly the market, in addition to the growth, the market changed and raised the question for the legislature to address how we should handle internet gaming and sports wagering gross revenues moving forward. So again, this table does not reflect or does not include the racetracks in it. So it's casino only for purposes of the pilot. All right, so what did the legislature do? So in the amended pilot, they addressed the issues by excluding all internet gaming and online sports from the definition of GGR for the last 5 years of the pilot, which is 2022 to 2026. So GGR for the pilot was defined statutorily as land-based casino gross revenue plus retail sports wagering gross revenue, basically all of the land-based gross revenues generated by the casinos in Atlantic City. That did not survive legal challenges. It survived legal challenges, but that did not preclude legal challenges. So there was significant litigation about the pilot. And one factor of that litigation dealt with the online gaming revenues and whether or not they should be included. The Superior Court ruled that the amended pilot was unconstitutional in October 22. That ruling was appealed and was reversed by the appellate division. That should be division, not DGE. In October, we didn't reverse it. So this should be the appellate division in October 2024. So the amended pilot was deemed constitutional, and that is in place today. But it currently is set to expire at the end of 2026. All right, last topic, understanding the revenue mix of an Atlantic City casino in 2025. So I want to kind of highlight before we get into this topic that there are a bunch of factors that make it difficult to understand the revenue mix of an Atlantic City casino. We can help you calculate that and make it kind of an apples to apples approach through history. At the end of the day, it's becomes much more difficult in 2025 because you have the internet gaming and sports wagering revenue included in one of the line items. So it's not as clean as it was historically, but you can still get a good estimate, and we will show you how to do that. All right, so look, when we talk about net revenue, our focus at the Division of Gaming Enforcement is basically cash revenues. Where are the casinos getting their cash revenues from? Most people on the presentation are aware that the gross revenues on the tax return include a lot of complimentaries and promotionals and cash giveaways. So that's that impacts the net revenue recognition, or getting from that gross revenue to a kind of a net revenue basis. Historically, it was pretty easy to evaluate the industry. It got a lot harder based on the 3 events, 2 of which we spent a lot of time on, which was internet and sports. Right. So, as you suspect from having third-party revenues, you're already going to have this difference between the online revenues reported by casinos that they're not receiving. So you're already going to have a kind of a reconciling item to get from the gross revenues on a tax return to the revenues reported by a casino on their income statement. The last piece is a new accounting standard that came out in 2019, which is ASC 606. The implementation of that made the comparisons of net revenue from 2019 forward a lot more complicated than they had been previously, and we'll walk through what that looks like as well. All right, so internet and sports, we spent a lot of time on that already. You're going to have a large revenue stream that's generated by third parties, affiliates, and joint ventures. So a lot of that revenue that is not going to be reported by the casinos. Again, gross revenues are very easy. Very easy to track to individual skins, and our press release now provides that information in a one-stop shop. But when it gets to the net revenue and profitability, it becomes a little bit of a different animal, and depends on the types of contractual arrangements and operations with regard to internet and sports. So as Charity talked about previously, when you look at a casino's financial statements, the only skins that are going to have 100% of their revenue and expenses are going to be the casino skins, but we only have 2 of them. All right, so that's not, in terms of the industry as a whole, not very helpful when only 2 of the skins are casino skins. For affiliates and third-party skins, the only revenue a casino is going to recognize is the money that they receive. All right, so if they have a third party that generates 100 million in revenue and they get 10% of that, they're only going to report that $10 million as revenue on their income statement. So that's where you see a lot of the differences between the monthly gross revenue amounts and the income statement amounts. For the Borgata joint venture, they do not report any revenues on their income statement. So Borgata's income reflects the income solely of Borgata, the casino hotel. All right. Third-party skins, another key point to keep in mind. When you talk about contractual arrangements, a casino and a third party can define all of the terms associated with how that payment is calculated. It's not, I think there's a notion, at least in our market, that, well, casinos must get a percentage of gross revenue. I don't believe that any casino gets a percentage of gross revenue. They get a percentage of a defined gross revenue or a defined profit. So when you're entering a contractual arrangement, the terms are between the contracting parties. So the casinos and the third party get to agree on how that revenue is going to be calculated. And in almost all instances, they're not based on the gross revenue reported to the Division of Gaming Enforcement. In addition, those agreements may have minimum payments, maximum payments, tiered distribution percentages, and upfront payments. So all of those kind of play a factor in what revenue is being reported by the casinos. All right, so that it may be that under some percentage arrangement, a casino is only due to get $200,000 from a particular skin, but the contract may state that they get a minimum of $1 million. All right, so that then the $1 million becomes the revenue. You could have it the other way where the percentage agreement may lead to a casino reporting $20 million or getting $20 million in revenue as the market access fee, but there may be a term in the agreement that limits it to $10 million. All right, so that would be the example of a maximum payment. You could have tiers, right? So that you could have 3% of it up to this amount and then 5%, right? So again, this is all contractual arrangements. At the end of the day, the point that we're trying to make is that there's no agreement that says, oh, you get X% of gross revenue and this is what goes to the casino. That's all based on the contractual arrangement. And as we talked about previously, those are proprietary. So we do not disclose what those terms are. We do not disclose how much of a casino's revenues or gross operating profit includes internet gaming. So from your standpoint in trying to evaluate the industry, you can evaluate which casinos don't get any payments from internet gaming, and then you know that everything is coming from the retail operation. Or if there is a third-party contractual market access fee, you can know that there's some amount of money included. You just don't know what that is. All right, so the last topic from this section is a summary of that ASC 606, and we'll walk through, how it used to be reported and how it gets reported now. I think this topic has created the most issues, for lack of a better phrase, in understanding the revenue mix of a casino industry, of the casinos in New Jersey. And so when we say revenue mix, we have casino hotels in New Jersey. They are not limited to only offering casino operations. They have rooms, they have food and beverage outlets, they offer entertainment, they have retail, and they have other sources of revenue. So there have been a lot of discussion in the past about, revenue shifts, or how much of our revenue comes from casino, how much comes from rooms, how much comes from food and beverage, how much comes from other, all valid discussion points. And before ASC 606, that was a fairly easy analysis to make. But because of 606, it became a lot more complicated. Again, we will tell you how to get there if you have an interest in doing this kind of stuff, and we'll show you how that looks based on the 2024 data. All right. So again, in the old method, it was clear. Each revenue category was reported on a gross basis, and promotional allowances or comps were deducted, and net revenue was synonymous with cash revenues. Again, we'll show you this on a table to hopefully make it a little clearer. Right. We make all promotional allowance data available through a Form 245, which is the schedule of promotional allowances and expenses, which gives users the ability to basically convert each revenue category from a gross basis into a cash basis. And we'll show you how that's done as well. So what did ASC 606 change? Unfortunately, from our perspective, it completely revised the revenue reporting for the casino industry. So all promotional allowances are incorporated into the casino revenue line, including those associated with non-gaming revenue sources. I'll try to put that in a little better English. What ASC attempted to do from the accounting profession standpoint was, if you were giving away food, if you were comping food and you were comping rooms, the motive, for in exchange for casino gaming, the value of that room should be deducted against casino revenue. So again, it was a noble approach, and I don't necessarily disagree with the approach. It just changes the math of the industry. So in the simplest of terms, if a casino comps a room valued at $200, they include that as basically cash received from rooms revenue and excluded that $200 from casino revenue. So as you can imagine, that creates a lot of complexity in understanding the cash revenue analysis under ASC 606. They also eliminated the promotional allowances and total revenue lines, which again added, in our opinion, to the magnitude of the confusion, because what you now see on an income statement is the 4 revenue categories adding up to net revenue. So I think the implication to some of the people utilizing that information was, oh, all I have to do now is divide one amount by the other and call it a day. So this next slide, and again, we'll get into the specifics of then and now, but this is just basically a thumbnail of what this looked like in 2006 and what it now looks like in 2024. So in 2006, you can see that the gross revenue that's reported on the casino tax returns essentially matches the casino revenue number, right? So again, it's then like, oh, okay, I get that, right? I can kind of reconcile from the month to the quarter. Then it provides the revenues from rooms, food and beverage, and other, and then it deducts those promotional allowances. So before, you had a total revenue line, which kind of signified to the users that maybe this is not necessarily the cash revenues, this is kind of the all-in revenues. And then I deduct what I gave away to get to the net revenue or cash revenue amount, which was 5.1 billion in 2006. Compare that to 2024. So now we have 3 different revenue streams: casino, internet, and sports, adding up to $6.3 billion in gross revenue. And I look at the casino revenue amount on my income statement, and I'm at roughly 1/4 of that. So that's the differences of the internet gaming and sports business, as well as the impact of the accounting changes. So let's take a look at each of those individually. We're going to start with 2006. All right, so again, the gross revenue on the tax returns matches the casino revenue line. That makes sense to most users. Each of the rooms, food and beverage, and other category has the promotional allowances included in them, as does the casino revenue line. So using the 245, we can take that 1.461 billion in promotional allowances and apply them to each of the categories to come up with a cash revenue from each revenue source. All right, so this is what it looks like. If you were looking at our press release at that point in time, the next slide, we're going to take that 1.461 and apply it to each of the individual categories to come up with the cash revenue amounts from each individual category. So that's what we've done here. So the first column is basically the same as what was presented on the prior slide. The promotional allowances column is the promotional allowances associated with each individual revenue source. So we had roughly 641 million in casino revenue, giveaways 329 in rooms giveaways, food and beverage was 437, and other was 54. Subtracting the allowances from the revenue, our net revenue was roughly 4.5 billion from casino, 167 from rooms, food and beverage, and other. And there's our percentage of cash rooms. So the thing I want to highlight here is that while the casino revenue promotional allowances are the highest of the categories, that's being applied against $5.2 billion. Okay, so proportionately, it's not as significant as rooms or food and beverage. So the way to look at this is that, on a gross basis, the casinos reported $496 million in rooms revenue, but of that amount, 329 million was given away as free. All right, so customers only paid $167 million in cash for their rooms. Right, so roughly 2/3 to 3/4 is basically given away. Same thing with food and beverage. Right, so you got 672 in gross revenues. You subtract the 437 in promotional allowances, you're at 235. So it has a significant impact in the proportions. So in 2006, we can see how casino dominated the market is. All right, so close to 90% of the cash revenues are being generated by the casino, and only 11% or so is by all other sources combined. All right, so again, casino-centric revenue component at the peak of the industry in 2006. Again, at 2006, it made sense, right? So we did not have the competition. The competition started largely after 2006 and forced us to be a little more mindful of kind of where our revenue sources are. Right, so for promotional allowances, 66% of rooms revenue and 65% of food and beverage revenue are comps. So using total revenue to calculate The proportion of revenues is of limited value from an analytical standpoint. Focusing on cash revenue, that's where you get basically 89% of all revenues are from the casino, and 11% is from all other sources combined. Excuse me. All right, so again, this is in DGE's opinion. We are not the accounting profession, but we understand what the accounting profession was trying to do. But in our opinion, the ASC 606 significantly distorts the cash revenue picture. Most casinos are coming in and paying cash to gamble. They're not paying cash for rooms, food and beverage, and other revenues. Yet the value of a free room is included in rooms revenue and deducted from casino revenue. So what that requires now is a little more detailed analysis to reconcile the income statement to present it on a cash basis. The key here is that when we can do this conversion, two things to keep in mind. These are more of an estimate than precision, but it gives us a good look. Also, thing that we also have to keep in mind is that to the extent that there are online or online sports or internet gaming revenues, most of those operators report that in the other category. All right, so now if you're talking about non-gaming revenues, there can be a portion of gaming related revenues in the other category. For those casinos that run their own skins, that revenue is going to be in the casino revenue section, so that doesn't create as much of an issue. We can still use the 245 under ASC 606 to convert the data to the cash basis. All right, so again, here's that slide where we have that significant disparity now between total gross revenue and the casino revenue as reported by the casinos on their income statements. We have much higher rooms, food, and other revenues, which are overinflated because of the complementaries. And to the extent those are overinflated, the reduction was to the casino revenue line. All right. So casino revenue on the income statement is now only 25% of gross revenue. Again, two reasons for that is the promotional allowances that are deducted, as well as basically the third-party internet and sports and affiliates as well. But we can get there through using the 245, and we've done that on the next slide. So the net revenue categories, if you look at our press release, that's what you would see, that $1,593 for casino revenue, $717 for rooms, $574 for food and beverage, $346 for other, total of $3,230. The $3,230 is a good number, right? That's the number, that's the cash revenues that are derived by the casinos during 2024. However, due to ASC 606, we now need to make the adjustments in the promotional allowance categories to deal with the promotional allowances that are included in the rooms, food, and other, and not included or netted out of casino revenue. So there's roughly $811 million of promotional allowances that we need to reclassify. All right, so that 811 we would add to casino revenue, and we would subtract that 811 from the other three categories to get to our cash revenue lines. So on a cash basis, we have casino revenue roughly $2.4 billion. Rooms revenue is $264, food and beverage $315, and other revenue of $247. From an analytical standpoint, and this is the key to this discussion when we're talking about the revenue mix from Atlantic City, there's a lot of published reports out there that simply take the net revenue in each category divided by the 3,230 and and present it as if we are a market that is roughly 50-50. We are not in any way, shape, or form a market that is 50% casino revenue and 50% revenue from other categories. We are not on a cash basis. But if you simply do that math, that's where you end up, which distorts the picture of an Atlantic City casino, because you see published reports saying, oh, don't worry, if casino revenue is going down, that's only half of the revenue mix. That is not the case. So on a cash basis, the amount of revenue we're getting from casino revenue is now closer to 75%. with roughly 25% coming from all three other sources. So in the Division of Gaming Enforcement's opinion, and in everything that we present to the governor's office or the attorney general, that's the data we're presenting to them, is that we're roughly a 75% casino market and 25% from all other sources. So we can look at over time, and we'll do that in the next couple slides, is say, well, wait a second, if we were at 90% casino revenues in 2006 and we're at 74, is that good in terms of revenue mix? And I would say, yes, it is good, but we have, as with anything, there's always caveats associated with that, in that when you're looking at proportions, all right, proportions are driven by the components. So if casino revenue is decreasing over time, on a percentage basis, that alters your percentage. So we'll look at that and try to get a handle on, historically where we have been and kind of where we are today. All right, so at our outset, the focus of the casinos was on generating casino revenue, with basically giving everything else away as a comp. Shouldn't say everything, but roughly 90% of the cash ran through the casino, maybe 10% ran through the other three sources combined. All right, so we never were focused on generating, in the early years, revenues from non-gaming sources. So prior to mid-2003, we were roughly a 90-10 revenue mix. So 90% of cash revenues came from the casino, 10% came from everything else. So what happened after 2003? So there were initiatives taken by the industry to kind of focus a little more on the non-gaming revenues. So when Borgata opened, their target market was those individuals who would be willing to pay cash for non-casino amenities. Tropicana opened, a hotel tower in the quarter, and other casinos added non-gaming amenities, but nothing really happened in terms of the percentages. So when we were at the peak of the industry in 2006, the percentage of revenue from non-gaming sources remained low. So we were at 9% and change in 2002. We were only 10.6 in 2006. So roughly, we were adding amenities, but we really didn't move the needle in terms of having non-gaming revenues be a more significant component of the revenue mix. So what happened after 2006? All right, so 2006, people can point to this wonderful trend, right? So, okay, so we were at, 9, 10, 11% for a bunch of years. And then we had this growth that started in 2007 through 2011. So, look, isn't this great? We were, we increased from 10 to 18% over a 5-year period. And I would argue with you that looking at this slide exclusively, I would agree with anybody who said that this was a good trend. The issue that you have to keep in mind was this is when the revenue market in New Jersey started to decline. So when we get to those 5 years, it raises the question as to, okay, I see that the contribution from non-gaming sources is increasing and getting to, a level much better than it had been previously. But is that because revenues from non-gaming sources are growing, or is there some other reason associated with that? All right. So again, historically, the gaming-centric strategy made sense, right? We didn't have a lot of competition on our borders. The focus could be on casino revenue, and we did very well in that category. Net non-gaming revenues had not been significant, relatively speaking. So we're looking at 9 or 10% through the first, say, 20 years of the industry's existence. But now we're at 18.2. So did I do something right, or did the casinos do something right during this time frame to really shift their focus and supplement their revenues? What we find is that most of the growth in that percentage was driven by how precipitously casino revenues had gone down. All right. So if we focus solely on non-gaming revenues during that same 5-year period, the growth in non-gaming revenues was only 12%. And that's for the entire 5-year period. So it's 12% over 5 years, or roughly 2.5% per year. That's not significant. However, casino win dropped 36% during that time frame. So again, it's simply a mathematical calculation. Because casino win dropped so precipitously, the percentage that comes from non-gaming revenue is going to appear more beneficial than it actually is. I guess the point being that, it wasn't because of non-gaming revenue growth that this percentage changed. It was because of the decline in casino win. So just got to keep that in perspective. All right. So when we look at non-gaming revenues at the division, we basically break it down into three kind of phases. First is from opening to the peak, right? So opening to the peak, we had roughly, in the best case, 11% of our cash revenues came from non-gaming sources. 89% came from casino. All right. Then from 7 to 18, we were having, kind of gradual increases in cash non-gaming revenue, but casino revenue deteriorating up to a point there where it was half of what it was during 2006. Because of that, we go from being 11% non-gaming to 22%. So factually, we did go from 11% to 22%. Understand that the basis for that change is the decline is more so associated with the decline in casino revenues than it was the growth in non-gaming revenues. So where are we today? So today we are around 26%, as we looked at on the previous slide. So again, this is a little bit better than we were before. But just keep in mind that the other revenue category includes the third-party skin market access payments, so that percentage is a little bit skewed. Still a good barometer, but it is a little bit skewed. So from a non-gaming revenue standpoint, that's how we view it. Again, other analysts or other people looking at the data can do things differently. Just understand the limitations associated with simply taking those 4 numbers and dividing them by the net revenue total. All right, so here's just kind of closing in this category to take a look at what has happened between 06 and 04. And this is simply cash versus cash. So it kind of gives you a very good insight into here's where we were and here's where we are. So our casino revenues are down 47% from our peak, and our rooms, food and beverage, and other are up significantly. Again, they're smaller numbers, right? So it's 167 to 264 on a percentage basis. That's significant. On a dollars basis, you could debate whether that's significant or insignificant. On a percentage basis, it is. So that's kind of our revenue mix then versus now. And that's how we get from proportion of casino revenue at close to 90% to today, which is around 75. Right. Again, the footnotes, just keep in mind that other revenue category, the most casinos report their third-party market access payments in that category. So there is a little bit of gaming-related income that sits in that category. All right, so non-gaming revenue takeaways. So due to SC 606, the way we calculate cash non-gaming revenue changed considerably beginning in 19. We can still calculate those. It just is a little more complicated to be able to do that. With regard to internet and sports, we have the ability, it's publicly known what revenue casinos are recognizing. But we do not tell you, and the casinos don't tell you how much of that revenue reflects internet gaming or sports. So the proportion of cash non-gaming revenues is less precise in recent year, but still a good estimate, and certainly a better estimate than simply using the income statements and dividing by 4. So with that, we will open it up to the group. So 2:43, that's a victory for me. So we got roughly 15 minutes left for any questions anybody has. Thanks for being patient. Some of you may have wanted to ask questions during the presentation, but given the number of people we had, it was a little difficult to do that. So Sarah, do you have anything for us? Are there questions for us?
Sure, Chris. There is one active question, and I'll read it out. Ms. Fisher asks, since third-party revenues are identified on the casino property's financial statement, would the overall revenue be skewed? If so, would this impact the casino property's financial stability? And would that pose a challenge if the casino needed to go through a material debt transaction?
Okay, lot to unpack in that question. So let's start with the third-party revenues. So the one thing that we want to make clear is that the third-party revenues from a tax basis, right, that monthly reporting, the third-party revenues are reported independently on the press release, and it is their revenue. So DraftKings or a FanDuel that is reporting $200 million in revenue, that's their revenue. It's not the casino's revenue. To the extent that there is a sharing arrangement, right? So an agreement between FanDuel and, let's say, Golden Nugget for the internet gaming. If they provide, let's say hypothetically, $10 million, $10 million payment to Golden Nugget, only that $10 million shows up on the income statement. All right, so that's the first distinction we want to make, is that the third-party agreements, it's the third party's revenues, and to the extent that there's a market access fee payment to the casino, that's what they would report on their income statement. Now, the good news from the casinos is that, yes, if they get $10 million from a $10 million market access payment from a skin operator, that is basically $10 million in income from them that they can use in any way they see fit. And it definitely, from a material debt standpoint, would enhance our view of that transaction. So for those who don't know, a material debt transaction is basically a debt transaction undertaken by a casino licensee or their parent company in New Jersey, where the casino is either pledged as security or guarantees that debt obligation. So those are required to be approved by us. So to the extent that there's internet gaming and sports wagering revenues and profits, that helps us. That doesn't mean that if there isn't revenues from sports wagering or internet, that it dissuades us or impacts us negatively. So a perfect example of that's Borgata, who runs all of their internet and sports through BetMGM. So, Borgata has no financial stability issues on its own. So it's not like we are sitting here saying, oh, they don't have, they're not getting distributions from this. It's a problem. It's not a problem for that particular casino. I think I answered all of the pieces. If there's any pieces of that I didn't answer, let me know.
Hi, Chris. Yes, that looks good. A question that we received earlier from the group that maybe I'll answer verbally is they asked if this presentation would be available later. We are going to post this recording on the Light website, and you will be able to access it there. And just now, I'm going to drop a PDF of Chris and Charity's slide deck into the chat if that's something that you would like to have later access to. Again, if you have any questions at all, please feel free to drop them in the Q&A just now. And of course, if something occurs to you later, please feel free to reach out to Christopher and Charity. As you can see, their email addresses are on the screen. And you can also reach out to light@stockton.edu. And we are happy to answer any questions or direct them to someone who can help. All right, so I'll let Jane bring it home, and thank you all for being here today.
Yes, thank you all on behalf of the Lloyd D. Levenson Institute of Gaming, Hospitality, and Tourism. Thank you for coming to the presentation and for staying with us till the very end. It was great to see. And of course, thank you to our wonderful presenters, Christopher Glom and Charity Yeoman. You made some very complex accounting information very easy to understand. So I think we all benefited from this wonderful presentation. So thank you, everyone.
Again, if anybody needs any information from us, our email addresses are there. Feel free to ask. A lot of the information that we covered was, there's, again, multiple steps needed to get from A to B. So feel free to reach out to Charity and myself. We'd be happy to walk you through the math. I mean, our goal here was twofold. One was to provide, some education about how this industry works, because it's not easy to understand. And a lot of times if you're reading articles in the newspaper, they're talking about gross revenues, and it's kind of meaningless without understanding, basically who the beneficiaries of those revenues are. Same thing with the net revenue analysis. The changes that have occurred in the industry over time have just made it a lot more complicated. We try to make as much, you will not find another jurisdiction who provides more financial information than New Jersey, and you will not find another jurisdiction that provides it as quickly as we do. So we are happy to be the leaders in that area. We continue to strive to enhance the public's understanding of what's going on, and that's kind of why we're here today. My thanks to Jane and Sarah and Stockton for hosting this. It could not have been an easier partnership to be simply the content providers and for them to do all of the heavy lift in getting us here today. I recognize that we had in excess of 135 people on, which is great. So again, I'm happy that you're all here, happy that you stuck it out. I tried not to make it as boring, or at least the least boring as I could. Thanks to my partner Charity in doing this with me so that people didn't have to hear me for 2 hours. And again, thank you all for attending.